All right, ladies and gentlemen, um, brief video today. We're just going to go over my actual stock portfolio and my crypto holdings and just see what exactly it is that I'm doing. As you can see, pretty small numbers at the moment, going through everything I got. Um, as a resident at the moment, that's kind of what I got, but shortly that's going to be going up. Um, but we're going to move on a little bit to the first thing. So we're going to go through my M1 Finance to start with, and then we'll do Robinhood, and then we'll do Coinbase, and we'll see what exactly is going here. So first off, stock portfolio. Total number, not that big, but a lot of it is return. I've gotten a good bit of market gain and earned dividends. So my kind of focus personally when it comes to what I do on the stock market is centered around earned dividends. Most of what I have in this portfolio is dividend paying companies, and that's pretty important to me as far as picking things to invest in. But they're not all dividend plays. There's a couple that we're going to go over shortly that are, I think, more interesting just because of their large capital gain, growth potential. So let's go through it. So one of my I guess the three biggest holdings that I have here are Realty Income, SPHD, and Noble. So these are two ETFs, all of which are dividend centric, and then there's Realty Income, which is a REIT, real estate investment trust, which I'm very heavily into. And actually, if you look at this discrepancy here, you'll see that I'm actually moving away from it a little bit. I guess we may as well start with Realty Income to begin with. So Realty Income is an amazing company. If you look at this whole portfolio here, there used to be more things that I was into. I've actually winnowed it down over the course of the past year or so. Once the pandemic hit and everything, I was, you go towards your strongest convictions. Realty Income is definitely one of the stronger convictions that I have. There's a reason I have still, even when I've moved away from it a little bit, 10% of it, as 10% of my portfolio is Realty Income. The reason I moved down is just because I was thinking about it, and it's like, it was at 13% earlier, and 13% in any single company is a lot. We're still not particularly well diversified if you have, 10% of your portfolio in an individual company. But there's a couple things about Realty Income that make me okay with potentially accepting that amount of risk. And there is a risk to that. Not only are we buying an individual stock, we're putting 10% of the portfolio into it. That's a lot. That's a really big amount. Realty Income is a couple things that make me really kind of bullish on Realty Income and willing to accept that risk. They call themselves the monthly dividend company. So they have monthly distributions. Every month you get a payment from Realty Income. And that's cool. Part of it is that their literal slogan is the monthly dividend company. In their earnings calls, their internal documents and stuff, or even on their website if you go there, they literally say the dividend is sacrosanct. They will never cut the dividend. Now, there are only three REITs, real estate investment trusts, in the dividend aristocrat category, basically. There's Realty Income, there's Essex Property, and Federal Realty. And so Realty Income they've never cut their dividend, and they've only ever increased it over time. Amazing track record, excellent management team. I'm really happy with how they're managed. If you listen to their earnings calls, they clearly have a good plan going forward. Their overall business model is great. They're a triple net lease REIT. They're a property REIT, not a mortgage REIT. Fuck mortgage REITs. So basically, triple net means that basically they give you the property, they lease it to you, and you're responsible for everything, like the actual upkeep of the property, taxes, maintenance, etc., get paid for by the person leasing the property. All realty income does is they sit back and they collect the money. And they have these long-term contracts where, you know, periodic price increases are essentially just factored in. At this point, they're trading for around, you know, $70.42, and their dividend yield is 3.91%. Market cap is $26.3 billion, so they're a larger market cap company. I have about 11 shares so far, and my average buy-in price is about 60, which is decent for now. You know, and the PE ratio, 76.3, that doesn't mean much of anything. REITs are not valued the same way that regular companies are valued. Depreciation for a REIT, for a property REIT that literally just owns the property and rents it out, depreciation doesn't make sense to factor in to valuation of a real estate investment trust. When it comes right down to it, basically, you look at something called funds from operation, or FFO, that factors depreciation back in, and then actually a bit more of an accurate accounting of their income is what they call adjusted funds from operations, AFO. That's when you factor back in capital expenditures like, I don't know, painting the walls and stuff like that. And that gives you a more realistic idea of how much money they're making and what their ability is to pay off their dividend. REITs are a tax-advantaged entity that don't pay qualified dividends. So actually, their dividends are taxed as regular income, which may be off-putting to some investors. So I personally am okay with that, but others may not be. Now, REITs otherwise are you know, a good way of getting exposure to real estate in a way that keeps you pretty liquid. You can still trade through the shares just like with any other stock. But oftentimes, you're going in because of the income generation potential for yourself. The tax advantage part also is for them, basically. So they get a tax break, but to be structured as a REIT, they need to put, you know, the vast majority, I believe it's 90+% of their money back into paying their shareholders, essentially. It works almost like a mutual fund. A real estate investment trust essentially works almost like a mutual fund, but for real estate. I want a good bit of exposure to real estate, and I think realty income is actually a really good way of getting that exposure. They do have some news coming up here. They do have a upcoming merger with VREIT. I don't know, a VREIT. I don't know if I'm saying that right. But once again, the monthly dividend company. I love that. And a quick word on monthly dividends, by the way. When it comes to dividend frequency and stuff, one thing that you're going to be thinking about is the compounding effect. The compounding effect between an annual dividend and a biannual dividend is significant. It's worth looking at. It's worth factoring that in if you're mainly focused on dividend income. Going from biannual to quarterly is also notable. But going from quarterly to monthly is often not as big of a deal. It's just the difference in the actual payout per share tends to not be so big that increased frequency actually makes that much of a difference. So quarterly versus monthly. Monthly makes me feel a little bit better to have that kind of consistent income stream every single month. However, quarterly dividends, you'll see that most of my holdings have quarterly payouts. And quarterly payouts are the most common type of dividend distribution schedule. Anyway, realty income is going to end up merging with VREIT, whatever the fuck, however you say that. And then they're going to basically sell off their office spaces, basically their office space properties in a completely different company. So they're going to spin off another company with basically just the office stuff from both Realty Income and VREIT. And then this is kind of a more share-oriented merger. Pretty much they're going to be issuing shares to VREIT shareholders, basically. And Realty Income is going to be the surviving entity, essentially. So Realty Income will continue to exist. VREIT is going to have a spin-off company, and they're going to basically give the VREIT shareholders Realty Income stock, pretty much. Now, the reason that they're doing this, they do see some kind of advantages, which of course they're going to have some really serious advantages, because like I said, the management for Realty Income they're responsible. They're quite good. They do foresee some immediate increase in their AFFO per share, which is great. That's kind of the big indicator of how capable a given real estate investment trust is going to be of paying you its distribution routinely. Increased and diversified scale driving growth. I mean, okay, it's basically assumed with this kind of merger, I think. Not really all that interesting, honestly. Enhanced leadership amongst blue chip benchmarks. Sure. I mean, sure. Okay. I mean, they're already pretty big. To put them in the top 6 largest by market cap, equity market capitalization, fine. I'm not that concerned about that. I like this. This is kind of a bigger deal to me. So Realty Income, as I had mentioned earlier, is already a dividend aristocrat, right? They've been increasing their dividend for more than the last 25 consecutive years. And with these kind of increased kind of ability to pay a dividend, makes their dividend as it is more stable, essentially. So there's that. There's a couple of other things in here. They're somewhat more technical. The strength of their balance sheet goes up overall. Their cost of capital advantages are so-called amplified. Cost of capital, basically, internally, when a company looks at whether investing money into a certain thing is worthwhile, they'll look at something like cost of capital. Cost of capital factors in like cost of debt and stuff like that. It's opportunity cost. If I put my money into this, how much do I expect to get back out? How worthwhile is it? It's good. It's fine. It's fine. It's still not one of my biggest kind of concerns here. Admittedly, I'm a bit of you're probably picking up at this point that I'm a bit of a yield chaser when it comes to REIT investing. With Realty Income, they're just so damn stable. I feel like you can get away with that. It's not necessarily the optimal strategy long term in every case, but these guys are just so dependable. Now, another thing that they point out is that they are the only net lease REIT with an A3 credit rating from Moody's, which, you know, if you go to the S&P ratings, I mean, it's an A-. So there's AAA, AA, you know, A+, A-. So there's a 7th from the top. So A3, they're quite good. About, I believe, 4 rankings away from junk bond, which is, you know, they don't have a lot of debt. I will say that their cash balance on their balance sheet was better before the pandemic. I believe it was something like $800 million in cash or cash equivalents. Now they're down to around $130 million or something like that. So they've gone down. They do have massive, you know, billion-dollar lines of credit and stuff like that. They have their own rotating credit facility that they can utilize, which I don't believe they've been utilizing very much at all. So as far as having money and not having as much debt, I'm a huge fan of this company. They've just been very responsible historically with being able to consistently pay out their dividend. And as a real estate investment trust, I really look for that. Whether or not that justifies my massive confidence in them, I mean, you tell me in the comments. Part of it is, I'm relatively young. I feel I can take a bit of extra risk. And if I'm going to take a risk, Realty Income is definitely one of those companies that I wouldn't be as nervous about doing that with. SPHD, it's an S&P 500 dividend ETF. That's once again very heavy in this, but dividend ETFs, S&P 500 ETFs are instant diversification. You're not investing with a single company, you're investing in basically the biggest companies in the S&P 500. So once again, I feel pretty comfortable doing that. The other nice thing about SPHD specifically is just that they have a monthly dividend, kind of like Realty Income. So I like having a couple of sources of monthly dividend income. What the fuck? What is going on with this thing? Anyway, SPHD, it has about $3.1 billion in assets under management. That's one of the things I like to look at for ETFs. You don't necessarily like things below around like 500 million. I'm more comfortable with having like more assets under management. It's a passively managed fund. The expense ratio is reasonable. It's got a pretty decent dividend yield, 3.7%, nothing crazy. But I'm super into SPHD, once again, for that consistent income source. They go with S&P 500 high dividend paying stocks, and they cut out the ones with the highest beta. So there's alpha and beta. Beta is essentially a marker of volatility. Alpha is a marker of basically yield. And they filter out the ones with the highest beta to kind of get their investment strategy. Noble, of course I have Noble, right? Like from what you've heard so far, I'm sure that doesn't surprise anybody if you already know what Noble is. So Noble is the Dividend Aristocrat ETF. It is basically just companies that have increased their dividend by, consecutively for at least 25 years straight, basically. This is once again an S&P 500 ETF, so instant diversification, but only diversification to companies with essentially the best track record, period, really. I mean, there's dividend kings as well. A lot of the time, the difference between dividend aristocrats and kings is essentially that they've existed for longer, although there are companies that will go on, some companies will go off the aristocrat list and new ones will come on all the time. 8.6 billion assets under management, big fan. Expense ratio, okay. Dividend yield, not as good as SPHD, but, once again, still good. This one pays a quarterly dividend, and it's been kind of okay. Haven't had an issue with this one. I do like Noble. I don't foresee there being any issues either, honestly. Noble is great. And then if my shit will start working again. SRET. So as you can see here, this is another one where I've started to move away recently. This is the Global X Super Dividend REIT ETF. So this is another one with real estate exposure. It's another one with a monthly dividend. It's another one that's an ETF, instant diversification. I don't necessarily agree with some of its top holding. I believe they have things like Iron Mountain and Chimera are kind of their bigger ones. And I actually used to own Chimera, and I kind of moved away from it. I'm not necessarily a big fan of how they run themselves. They have actually started performing better recently, but still I'd rather, at best, prefer indirect exposure to them. As far as REIT ETFs, there's one of the decent ones as far as assets under management, 509.8. Dividend yield is pretty solid, but the expense ratio is also pretty significant. Higher risk, higher reward kind of ETF, and they're very centered around yield. It's all about what kind of dividend the REITs are paying out, and it's a global REIT ETF. So actually, I believe 70% or so of their holdings are U.S., but then 30% is outside of that, Canada, Singapore, and other places. And so that's basically what they go for. They go for the biggest yielding ETFs, or sorry, the biggest yielding REITs, and then they cut out, I believe they cut out also high volatility as well. But they're really chasing yield in this case. But I am moving away from that. I think we can actually, because at the pandemic, if you compare that to one of the other REIT ETFs we're going to go over later, VNQ, all of the real estate stocks ended up taking a good bit of a hit. But as far as from a recovery perspective, they've recovered. It was SREP, that is. They've recovered slower, basically, than the others. Now, what else did we have? Fucking all of this got. I don't know what's going on with M1 Finance right now. Next biggest one. Basically going into WP Carey and Spider. So Spider is very self-explanatory. It's the S&P 500 dividend ETF. It's been performing like gangbusters, as you can see. I'm pretty consistent with contributions into it. It's about 7% of the portfolio. Not a whole lot to say specifically about Spider. It just consistently performs, honestly. S&P 500, highest dividend paying companies, and I believe it's just market cap weighted. And it's been doing really well. I don't plan on changing that at all. $1.6 trillion market cap. The fuck? That's Amazon. I was like, ETFs don't have market caps. Dude, M1 Finance is fucking bugging on me as soon as I decide to make a video. This is kind of pissing me off a little bit. Anyway, WP Carey is another REIT. It's not a dividend aristocrat, but it is a future dividend aristocrat. Literally, the reason it hasn't become a dividend aristocrat yet is just because it hasn't existed long enough for it to be a dividend aristocrat. So it has a quarterly distribution. It has pretty solid funds from operations. I'm pretty happy with WP Carey, and I'm glad to be getting in on kind of the ground floor before they actually become a dividend aristocrat. Oftentimes, joining Noble, just the fact that you've become a dividend aristocrat, kind of increases your stock price just from that news. Not that that's typically like a long-term gain or anything. As you can see, they got a 13 billion market cap. It's kind of like a mid-cap company, a little bit higher than mid-cap if you consider that 10 billion is the cutoff for that. But once again, it's a REIT, so the PE ratio doesn't really matter. Pretty decent dividend yield. Fuck you. And it's going for around 78. So my buy-in price being 70, decent for now. We got a couple shares in that. I can't wait to be able to put more money into this, honestly. They're another one where I'm a huge fan of the management. They seem to be pretty responsibly managed. I believe they're also a net lease ETF, or net lease REIT, which as a business model I just think is wonderful. I'm a huge fan of the net lease REIT business model overall. Literally just like get paid. Your job is to get paid. You just get money. It's amazing as a business model. It's excellent. You almost want to go and like make a REIT. It just is amazing that you can even do that. Then here comes some of my individual stock investments. I don't use a lot of individual stock investments, but Amazon and Disney. Amazon, Disney, Tesla, Google, Microsoft, JP Morgan, Netflix, and Apple are exceptions that I make outside of the REIT space. The REIT space is more just because I want exposure to real estate, which has historically been an inflation hedge, but also just a very consistent source of passive income. Amazon does not pay a dividend, but I mean, let's be serious here. Amazon is Amazon, $1.6 trillion market cap. You could say that it's overvalued based on its PE ratio being well above 15 at 60.1. But I actually don't even think that's true. I don't think that's necessarily true. They put a lot of their money back into their business, and they expand aggressively. I mean, aggressively. Amazon at this point, there's not a lot of stuff that they're not into. They essentially have full-on monopsony power. They are just expanding into every single possible. They're going into gaming. They're going into health. They obviously have just about all online transactions cornered. Amazon Web Services is almost like if you take between Google, Amazon Web Services, and Microsoft Azure, that's, I believe, the majority of internet storage capacity and cloud services. So Amazon Web Services is a huge player, and they essentially can fund the rest of their businesses with just that. That's part of why they're able to kind of just outperform a lot of other businesses in the industries that they end up diversifying into. Obviously, remarkable per share price. I don't even have a full share, but my average price is $28.12, which compared to right now is pretty good. But I actually expect this to go up a good bit. Amazon is killing it. Jeff Bezos isn't charismatic the way Elon Musk is. He's not a meme king like Elon Musk, but I mean, Amazon is killing it. Absolutely killing it. They're amazing. Like I said, they essentially have monopsony power on a lot of online purchases, which puts them in an amazing position overall. And then there's Disney. Disney, I mean, do we need to talk much about Disney? Disney is Disney, Excuse me. $321 billion market cap. They cut their dividend, but I'm not going to sell them because of that. I don't hold that against them at all. I think that was a good kind of decision for their business going forward. They should be using that money to reinvest in their business. They've reorganized in towards a streaming-oriented business model. Historically, they've been they've gotten a lot of money from their parks, which obviously during COVID-19 has not been working as much. But now they're essentially trying to compete with Netflix. And there's a couple of reasons I think that's potentially a great idea for them. One is that the subscription model of business is really good. They're just long-term, consistent income-wise. Subscription is great. Disney, on top of having their standard subscription model, can get away with things that other people just can't. Like, for instance, giving you a subscription like Disney Plus and then forcing you to pay to watch Mulan at a certain time on Disney Plus on the subscription platform that you're already paying monthly payments for. Nobody else can do that. Netflix couldn't do that shit. Nobody would put up with that from Netflix. Disney is Disney. It's like a separate, different class of asset. People are willing to just look at Disney completely differently. It's crazy. But Disney is also American culture. That's the other thing. That's my fundamental investing thesis behind Disney. Disney owns everything. Okay, let's take a look at what Disney owns. I think this is really just telling, right? When you're investing in Disney, you're investing in this, right? This is crazy. This is next level, right? They have Marvel, You know, they have all of Marvel Studios. That's all just Disney. We knew that, right? That's not surprising to anybody. Fox Entertainment Group, Fox Sports, 20th Century Fox, FX, all of that is Disney. Nat Geo, that's Disney too. You know, they have their own music group, right? Where did Ariana Grande come from? Where did Drake come from? Where they all started off in basically the Disney media kind of environment. And then they became their own thing. But like Disney picks winners. That's what they do. That's just how it works. If you come from Disney, you end up doing really well. They have History Channel. Vice is theirs. You know what I mean? Disneyland, obviously there's the parks. But the parks are just this yellow part. You know what I mean? They also have their own realty companies. You know what I mean? They have construction companies. Obviously, then there's just, you know, the Disney direct-to-consumer part of the business. Disney owns Hulu. I don't know if you knew that. Disney owns Hulu. They already have a subscription streaming service, which potentially they could roll into Disney if they wanted. ESPN. They own the majority stake of ESPN. If you watch ESPN, you are a Disney customer, essentially. So, yeah, and ABC News. I mean, they own everything. Disney owns everything. That's the thing that people don't get. One time people, you know, sometimes you hear that if they're getting into streaming, the production costs are just crazy. Well, look, who do you think is more able to subsidize those production costs? Netflix, which is also a company I hold. I think they're doing really well. I think they're going to, we'll talk about that in a second. Or Disney, right? Look at this. This is crazy. They have so much business under one roof. Their ability to subsidize anything at all is comparable maybe even to like Amazon. It's very impressive. So I'm a huge fan of Disney. Disney is American culture. If you look at all those properties that they own, Disney owns your mind. They have rent-free space in your mind. That's who Disney is. But still, just 3%. In the name of safety and, you know, diversification. I already went 10% on fucking realty income. You can't go too hard on other things when you do that. But to be fair, you know, I also still got 7% WP carry, so that's a lot. VIXIS, very, very kind of a standard inclusion here is VIXIS. VIXIS is just an international stock ETF. It really just pays a decent dividend, ultra low expense ratio, 395 billion assets under management. I mean, it's good. It's ultimate diversification, essentially. It's just the whole international stock market, really. Bought an average share price 56.6. We're up to 67. It's decent. You know, we're doing okay on it. It's more of a diversification play. I just want to make sure I have enough of that kind of thing in there. The NASDAQ TDIV, so that's the NASDAQ ETF, 1.6 billion under management, 0.5 expense ratio, 1.7 dividend yield. Once again, okay. It's not the S&P 500, but this does let you track kind of broad tech stocks, which of course, if you're going by market cap weighting, that just means that I'm essentially holding a bunch of Apple indirectly. Apple is just huge. Apple, Microsoft, these are probably some, you know, make up a lot of the actual value of TDIV and the NASDAQ at any given moment. So as far as average share price, I bought around 52 and we're up to 57. Fine, you know, it's okay. Another one, it's not the S&P 500. Tech stocks, especially now, have been doing a little bit better, but I don't expect that to necessarily be one of my biggest plays, and it hasn't been so far. We'll see. Tesla, I'm gonna be honest with you. This is just I don't have as much of a. I didn't go into this with as much of a rigorous investment thesis. I was literally just like, hey, Elon Musk. You know, it's a two-word investment thesis. Elon Musk. That's it. You never bet against Elon Musk. That's pretty much why I have any Tesla at all. when I was first investing. Because ultimately, look at this PE ratio. Look at this PE ratio. This is the craziest shit I've ever seen in my life, right? 518.9. It's trading at 599. Like what? What is happening? You know what I mean? Like that's ridiculous. Is it worth that much? Should it have a $577 billion market cap? Probably not. Probably not. There's a lot of speculation built into the Tesla market cap and its share price. It's very speculative. It's very risky from that perspective. However, if you look at what they're going into, I mean, they're an energy company, a car company. What is it, like Switzerland or something? There's a European state that literally has like 60% of their cars are just straight Teslas. Like everybody has a Tesla. It's unbelievable. They have incredible market penetration into certain markets. Not quite the U.S. yet. Once they get fully automated driving, get out of here. Like I think they're going to really, really take over once that happens. Once they build, but they also have to get finished building their infrastructure, all their mega charger stations and stuff like that. That's really important to do. But they're going to have that Cybertruck. Not personally a fan, but it's a thing to consider. The Tesla Model S, they want to bring down that price point, I believe, to close to the 30,000 range. We'll see. Their whole point is to try and make electrical vehicles affordable for the average person, and around 25 to 30,000 mark is roughly where they're going to have to get that in order for that to be viable. They're hoping to do that in the next few years, so we'll see how they do. They hope to do a lot of things, you know what I mean? It doesn't always pay off on schedule, but they tend to ultimately follow through on a lot of their promises, and it's Elon Musk, so friggin' let's do it. This is definitely, obviously, one of those companies that I'm going into that does not pay a dividend. But I think especially going forward, I mean, you know how Kathy Wood is talking about Tesla. She thinks it's going to go up to like fucking 3,000 or some crazy shit. Even Elon Musk was like, "All right, how about you calm down on that? That's crazy." She's making a lot of assumptions about Tesla because they're adding insurance to their they're doing insurance now too, I guess. And she's more or less assuming that they will take over insurance. You know what I mean? They're going to take over insurance from the current giants in insurance. They're going to take over cars. They're going to take over energy storage. That's very optimistic. I'm optimistic on Tesla, but that's too optimistic. I have a pretty solid price point for Tesla, but not like that. That's crazy. And then VIG, once again, the Dividend Appreciation Fund ETF, another very standard inclusion in a portfolio like this. 71 billion assets under management, pretty comfortable with that. Pretty low expense ratio, moderate dividend. It's fine. It's good. It's actually a good fund overall. And then, my average buy-in price is pretty decent, about $15 below the current price. It's all right. I'm a fan. VIG is a good holding to have. I have no real regrets on that one. Federal Realty, another one that I'm actually going more into right now. I'm kind of transitioning more into having more Federal Realty. Quarterly dividend, real estate investment trust, good adjusted funds from operation. Dividend yield, pretty good. Ignore this. 9.1 billion market cap, so it's a mid cap, but it's also a dividend aristocrat. Very, very solid long-term kind of income, basically. So this is something that I have growing confidence in. I've done more research on it. I'm a pretty, confident one here. It's a shopping REIT, basically, and that is somewhat concerning. It's part of why I wasn't as interested to begin with. Because frankly, especially the mall model of shopping, I think is going to go away. I used to own Simon Property. I don't own Simon Property anymore. They're actually performing pretty well right now, but I have no faith in the future of mall REITs because I think malls are going away. I don't think we're going to have a lot of malls in the future. But Federal Realty is more, diversified. They're not just a mall REIT. I'm usually more interested in like industrial or retail equity REITs. I don't do mortgage REITs. I've already told you that they're a lot more risky. I don't like their business model overall. What else? Google, Microsoft, JP Morgan Chase, Apple, Netflix. So we'll just tackle a couple of these together. More involved investment theses on these. We can do that, but that would take a hot second to actually do. Google, I think some of the biggest upside potential in tech right now. Google is just part of everything. Alphabet is part of everything. Google has YouTube inside of it, and YouTube by itself is basically bigger than Netflix. I mean, it's unbelievable. It's crazy. So Google is that big of a company, and I think they have a lot of control, essentially. We Google everything. Google is a verb. Google has control over information. They don't just have revenue. They have power. I like that. Microsoft, I think, is an easy one to sleep on because you kind of figure, at least I kind of figured that Microsoft is a dog that has had its day. They were that monopoly. They were monopoly busted. They were in the news for a long time because they were getting their Windows system. There was an issue for them. They were a monopoly, and it was a bad look. But these days, if you look at all the antitrust stuff going on, Facebook, all those other companies that got taken up to Congress and stuff, Satya Nadella of Microsoft really wasn't a big target in any of that. Microsoft is kind of keeping its head down and kind of dominating really nicely. Their revenue and stuff has been going up pretty steadily. They have Microsoft Azure now. Microsoft Azure is part of the Ethereum economic, entrepreneur, Ethereum Enterprise Alliance, my bad, the EEA. And it basically runs on Ethereum, which is part of the rising bull case for Ethereum, which we'll talk about when we get to the Coinbase stuff. But yeah, I mean, 1.9 trillion market cap. What else are you going to say about that? They're the OG of tech, basically. That actually did well. A lot of their stuff is they still have a pretty solid foot in hardware, but they have a lot of software stuff that they do these days, which I think is a really good direction for them. JP Morgan, I wanted to have a little bit of diversification into the finance sector as far as banks. Out of the banks, I dislike JP Morgan the least. And ultimately, they're doing pretty well in like auto loan and credit card sectors. They're a universal bank. They make their money. You know how a bank works. You've interacted with banks on a regular basis. Part of why I didn't, I used to own Bank of America stock, and I actually bank with Bank of America. But there's too many stories of just poor customer service and people just not liking Bank of America. Part of that might just be, bias against bigger banks, in which case JP Morgan is potentially not immune from that. But JP Morgan is reasonably well managed as far as banks go. They're one of the biggest and most valuable by market cap in the United States for sure. Apple, 11th largest company in the world. Not a lot to say about that. Massive amounts of cash on hand, doing remarkably well. They're diversifying towards healthcare, essentially, health-oriented devices. $2.1 trillion market cap. Fun, crazy. They do pay a dividend, which is great. I don't think there's any reason to ever expect them to cut that dividend anytime in the near future, so that's wonderful. P/E ratio is 27.5, which might suggest that it's a little overvalued, but I don't think so. Their ability to kind of increase, they're almost like an Amazon, honestly. Their ability to just step into anything and just blow everybody out of the water and increase their earnings over time is just incredible. I would not underestimate Apple. Netflix, we've already talked about. Netflix, the big question that a lot of people are asking is how are they going to keep increasing their subscriber numbers? Something like 60-70% of their subscribers are currently in the United States and Canada. I think going forward, their big push is going to be kind of diversifying where they're subscriber numbers come from, overseas kind of revenues. But then also, obviously, you may have already heard that they have a bit of a push towards gaming. Potentially, we don't know the nature of that. Maybe it's going to be like an Apple Arcade type thing where they offer a few games, or otherwise they'll just start doing like an Amazon and just trying to make big AAA games and stuff like that. I have mixed feelings about that, to be honest. We'll have to see how that goes. I mean, the reason I have Netflix is simply because there's such an established juggernaut in the streaming game. Streaming is an excellent business model, very consistent income. But as far as how the gaming thing goes, we'll see. Because if original content is expensive to make, AAA games these days are very expensive to make. You really have to be able to sell your stuff in order to do well with AAA game development. Last but not least, JEPI and VNQ. VNQ is so new that literally I don't have any yet. So M1 Finance is nice as far as having automatic trading stuff. Putting in a little bit of money. We're going to be buying some VNQ tomorrow. I'm excited about that. It's basically where the other, because SRET, like I was telling you earlier, used to be 10%. That 5% went to VNQ. I think overall they've been performing better since the pandemic. And in terms of just overall numbers, I doubt SRET is actually going to keep up. The trade-off there is monthly versus quarterly dividends, but SRET, they've actually cut their dividend overall, and it's a very inconsistent dividend. VNQ is much more consistent, and it's all, once again, real estate investment trusts. They got $74 billion under management, so much bigger than SRET. Pretty solid expense ratio, good dividend yield. Pretty happy with that overall. And then JEPI. JEPI is an interesting one. It's a new one. I had to think a little bit before kind of going into this one. I want to see how it works out. It doesn't have enough of a track record. I mean, look at this, right? Not much there. That's actually my personal stuff. But if you actually wanted to look at JEPI overall, it's here. Not a lot of fluctuation there. JEPI is the JP Morgan Equity Income ETF. Amazing dividend yield, reasonable expense ratio, solid assets under management, and basically the way that they invest is interesting. So 80% of their assets go into equity-related notes. Ultimately, what this ends up being is basically like a covered call ETF that's trying to replicate some of the returns of the S&P 500 using dividends without as much capital gains potential, essentially. So if you look at their actual description, they're trying to go as much towards the S&P 500 total return index while decreasing risk. So they're another type of fund that kind of filters out high beta companies. But once again, a lot of its asset is these equity-related notes, which essentially amounts to the ETF being a covered call ETF in disguise, which is okay. It's okay. The thing about it is that it is very much geared toward reliable income. It's not really much of a capital appreciation kind of play, but most of my portfolio here is not really a capital appreciation kind of oriented thing. So that's all of the holdings. The criticisms of this type of portfolio are very obvious. I pointed out multiple times that there are some real weak points as far as diversification. I mean, 10%, 7%, into individual REITs, 6% in another REIT. Two of them are dividend aristocrats and one is about to be. But still, that's not necessarily a good setup, broadly speaking. as far as how to set things up with individual companies. 59% of it is going to be ETFs at this point, the way it's currently allotted. Once we actually get to 5% on VNQ, 3% to JEPI and stuff like that, it's going to be about 59% ETF, so reasonably well diversified, but with these big whales at 10%, 7%, 6% for individual companies. You could argue that you should maybe keep any individual company's weight in your portfolio 4% or less. And I do that for the most part outside of those companies. I just have very heavy individual REIT exposure. So there's that. 41% up so far. So pretty darn good, at least from my perspective. I'm a fan of how the monthly dividend income is shaping up. You end up getting SPHD at the end of the month, Realty in the Ides of the month, SRET around the Ides of the month. We'll see about JEPI. I believe JEPI is also the end of the month. I could be mistaken on that. So that's M1. That's my stock portfolio. Some pretty obvious weaknesses, but ultimately I'm willing to accept a bit more risk just at this point in my investing kind of timeline. Let's briefly touch on Robinhood. I don't have a whole lot on here. Robinhood is basically my throwaway. All of this is just stuff that I happen to just be in. For some reason, the stocks portion of it doesn't consistently load. I don't know what's up with that. Maybe it's something on my... There you go. Okay, it disappeared again. Whatever. It's Palantir. The only stock I actually have on this is Palantir. It's a meme stock. But that doesn't mean it necessarily doesn't have real value. Palantir has strengths and weaknesses. It's heavily invested in government contracts. Palantir is a company that essentially takes big data and tries to make sense of it. They kind of suss out the patterns in metadata and stuff like that, and they'll give companies tools for analyzing their own metadata and seeing who will buy from them and what they can do to get better profits, essentially. They also help the United States invade your privacy. And I figure, I don't necessarily agree with that, but I'm willing to profit off it because I'm a questionable ethics kind of person. So that's Palantir. I just slowly DCA into Palantir. We'll see if it goes up. We'll see if it doesn't. I think it has a lot of potential, but it may never realize any of that potential. It'll probably take years before it even gets very profitable. It will definitely take years before it gets particularly profitable. So it's more of a long-term play. I want to see how it plays out. We'll see. It may not go anywhere, but I'm not putting a bunch of money. It's like $10 a month. I'm going in there. Dogecoin, fuck it, why not? Why not? It's just, I like riding the roller coaster. That's just a fun stock. I don't actually have much invested in here. It's 37 cents a coin. I figure just to say that I have it, so that when the next Dogecoin meme thing happens, we can just be like, oh, hey, Dogecoin. And then Ethereum Classic. Ethereum Classic I actually have a pretty serious bull case for. Long term, it is proof of work. They don't plan on changing from proof of work. It is a Generation 2 cryptocurrency with programmable smart contracts. Ethereum Classic. Long term, there's not going to be a lot of other proof of work blockchains out there outside of Bitcoin. And if you're going to compare Ethereum Classic versus Bitcoin, I think the value proposition of Ethereum Classic is drastically greater than Bitcoin's. Whether that actually comes to fruition in terms of real world price, that's why I have it held in Robinhood. Initially, I wasn't too sure. I'm more sure. I think Ethereum Classic is actually going to be a really good long-term play. I know there's Etherplan. If you read their investment thesis, they actually see in the next decade or so Ethereum Classic may go up to 7,000 a coin. That may be a little bit optimistic. Apparently this spike right here, where they saw the blow off top and came right back down, where they'd gone all the way up to like 149 on Robinhood's exchange price. Some people mistakenly bought Ethereum Classic because they thought it was Ethereum mainstream. And I guess it was a mistake, but it hasn't already rebounded all the way back down to anything. It's actually having a nice support level around like the 50 range, which is somewhat encouraging because I bought in when it was like $17. If you look at the portfolio overall, I've only put in $217 into this, and I'm at 2,073. That's all just gains, mostly from Ethereum Classic. Ethereum Classic skyrocketed. I mean, I expected it to go up long term and maybe even hit that 7,000 price point, but not, I didn't expect it to go up this much in the short term. So we'll see where that goes in the future. Now, keeping this stuff on Robinhood is questionable. They say they want to make it a true crypto wallet in the near future as soon as possible. Whatever that means. What is as soon as possible, we'll see. Robinhood I don't really trust. At some point I may look into taking everything off of Robinhood. I'm not a fan of them as a company overall. They have a lot of public trust issues at this point. I just don't like them. But at least for now, we'll keep the ETC here. We'll keep the Doge here. Maybe move it into Coinbase in the future. Coinbase, speaking of, recently started listing Dogecoin. I don't hold any Doge on actual Coinbase, but I do hold other cryptocurrencies that I actually have some conviction in. Cryptocurrencies, I think, are definitely a sector where you have to have, where you should mainly invest in the coins that you have the biggest conviction in. And ultimately, linking back towards the M1 stuff was JP Morgan. JP Morgan is actually part of the Ethereum Enterprise Alliance, and they are actually offering more and more crypto-based services. So I think that's pretty bullish for Ethereum. So of course, naturally, I do hold Ethereum and a little bit of Ethereum Classic on this one. Brief word on the interplay between Ethereum and Ethereum Classic. They both run on basically the same underlying code. Smart contracts on Ethereum run the same on Ethereum Classic. Difference being that in the future, as Ethereum shifts to ETH2, becomes proof of stake, there will no longer, over the course of the next, I believe, year or so after the switch, there will be a phase out of mining. And so miners, I think, especially ASIC miners, will end up, instead of just throwing away their hardware, probably end up mining a bit of Ethereum Classic, provided that there's enough use of that particular blockchain to justify actually mining it and making it profitable. So a little bit of Ethereum Classic that I hold here. Remember, so the current state of the crypto market is essentially, it's the context of like a 50-60+% correction in Bitcoin. Remember, the altcoin market is at this point still very heavily pegged to the price action of Bitcoin. So Bitcoin is all the way down to 36,000 from an all-time high of 64,000. I mean, it's a significant correction. It's a great time to buy. It's an amazing time to buy. This is definitely the time to buy. Actually, fuck it. I'm gonna buy a little bit right now. Yeah, I'm just gonna buy a little bit right now. Fuck it. Let's do it. It's a great time to buy. Bitcoin is the best performing asset of the last decade. It's the most held cryptocurrency in the world. 70% of Americans hold at least some Satoshis. Its current price, I mean, I think it'll definitely blow past its previous price of 64,000. You're looking to at least double your money in the next couple of years easily, and I think that's a no-brainer. I mean, you got to have Bitcoin. People are actually getting to the point where they're actually advising. Actual financial advisors, of which I am not one, are telling people to actually put their money into crypto as part of their retirement plans. So Bitcoin has done a lot in terms of legitimizing cryptocurrency as an asset class. They previously didn't even acknowledge it as an asset class. Goldman Sachs recently came out and said that it was an asset class after they already stocked up on a bunch of Bitcoin during a dip. So I don't expect anything other than that from them. Other stuff. Forget about Stellar Lumens. Forget about Internet Computer. We're not going to talk a whole lot about them. I have a little bit of that. It's not something that I consider a really, or in Tezos the same as well. I don't consider any of those significant portions of my portfolio. I just bought a little bit of that just for shits and giggles, I guess. But more interesting stuff. My DeFi plays are Algorand and Cardano. Currently, Cardano is 105. Okay, I mean, all right. So I've bought a good bit of sub $1 Cardano, Algorand, which I think is great. And it's been heading up recently, but really I do think we're essentially in a bear market right now because of the price of Bitcoin. It might be a second before it actually starts going up, which I think is great. I mean, it's great. I mean, look at the all-time high on Algorand. It's 186, right? 186, it'll go back up there. Next time we go into a Bitcoin bull market, mark my words, it'll go back up there and more. So getting sub $1 Algorand right now, I mean, it's an easy way of doubling your money and more. Algorand is, by the way, its value proposition is really quite something. It's it's a DeFi play. It is what they call pure proof of stake blockchain. Very environmentally friendly, very fast. It has some of the most cutting edge second generation cryptocurrency technology in existence, really. One of its main competitors, at least in my eyes and in my portfolio, is Cardano. Cardano is awesome. I am a huge Cardano bull as far as where I think it's going to go. It has a lot of similar technology. It's once again proof of stake. They're actually, Charles Hoskinson also worked on Ethereum, technically also as a Ethereum founder, Ethereum Classic. And he is working with IOHK to develop Cardano. It's the most actively developed cryptocurrency in existence right now from a developer perspective. It's fourth most held on Coinbase. It's one of the biggest by market cap. We may as well just look at that real quick as well. So by market cap, there's Bitcoin, Ethereum, Tether, Binance, and then Cardano. Doge is right below it. That's fucking crazy. I mean, the inventors of Doge literally sold all their Doge because they were like, this is a terrible idea. We made it as a joke. It wasn't supposed to go anywhere. Now it's the 6th largest cryptocurrency by market cap. This is the craziest shit I've ever heard in my life. Like, this is ridiculous. It's a joke that made it as one of the biggest financial assets in existence. That's one hell of a joke. Cardano is number 5 right now with like a 54, billion dollar market cap. It was, we're trading off with Binance Coin and Tether. Tether is really high up there right now. USDT, I'm not personally really into those stable coins. I don't care about that. Fuck that. Ethereum and Bitcoin are the biggest right now, and I'm very bullish on Ethereum. I think as far as technology, Algorand and Cardano are better, plain, pure and simple, period, end of story. Ethereum is a dinosaur in the space, but because it's so old by crypto standards, it has much more adoption. One thing that's really huge here, as far as the bull case for Ethereum, is just the Ethereum Enterprise Alliance. If you just look at who's actually in the EEA, I mean, Aave is another decentralized coin. It's a token on Ethereum that is, I believe it's a lending token. It has loans. Like, it's kind of a big deal, honestly. Who else? Bank of New York Mellon, kind of big. I like seeing those kind of big names. Consensus, bigger player in the crypto space as well. There's another Robobank. Obviously, the Ethereum Foundation. Interesting that they actually listed themselves on the Enterprise Alliance. FedEx is in there. What else? There's actually more. J.P. Morgan Chase, like I had mentioned earlier, John Hancock Life Insurance, Microsoft Azure actually runs on Ethereum, as I mentioned earlier. Polygon we'll talk about in a second. The Matic token was invented as a layer 2 solution for crypto, as you know if you watch my recent crypto video. What else? VMware, they're a pretty big one. Yeah, so that's part of the huge bull case for Ethereum. They have the technology, they have the smart contracts. They're running into some issues with gas fees and stuff right now. With ETH2 and all their plans for transitioning to sharding and the beacon chain and stuff like that, I think they're going to end up overcoming a lot of their current issues. And with the amount of first mover advantage they currently have, their price point is going to go, I think, way past Bitcoin. Ethereum, the flipping is borderline guaranteed. In my mind, it's a guarantee. Ethereum will flip Bitcoin, period. End of story. Now, then it becomes a question of will other second generation cryptocurrencies then flip Ethereum? Are we going to see that much upheaval? That would be crazy. We'll see. I mean, I wouldn't even know. The dynamics of the crypto market entirely would be changed if that ended up happening. But here with Cardano, like I said, better technology. Their current push is in Africa. So they have a couple of African countries that are literally going to be using Cardano for multiple functions. Like, for instance, education, I think, is a big one. They're pushing towards education, keeping track of like students' grades and stuff like that on blockchain. Potentially becoming the currency for a bunch of African states, which, of course, given that those states don't have a bunch of money, total to begin with, it's not going to be something that just pushes up the market, the share price or the coin price, just by adding money to the market cap. However, it's going to have an increase in value by Metcalfe's law because of the increase in number of wallets and users. So that's really exciting for the evaluation of Cardano. So I'm a huge Cardano bull, huge Algorand bull. Chainlink. So Chainlink, I think, is the most promising Oracle play in pretty much the entire crypto space. Huge fan of Chainlink. So Oracle plays are essentially, if you're going to have your blockchain do something that interacts with the real world, and you need information about the real world, you need an Oracle. Oracles basically tell your blockchain what's going on and allows it to make smart contract decisions by just informing them and plugging in outside information. 14th biggest coin on Coinbase, $12 billion market cap. Its all-time high, I believe, was somewhere in the 50s. Yeah, 52. So it's down to 27. So once again, easy way to double your money. Once again, none of this is financial advice, but their underlying fundamentals, I'm a huge fan of Chainlink. I think Chainlink is a really good way to go if you want to have an Oracle play in your portfolio for crypto. I do try and have all those different elements of DeFi. I have a bunch of DeFi plays. Ultimately, DeFi is, I think, the biggest thing that I'm going into. Bitcoin is mostly a store of value. Cardano, Ethereum Classic, Ethereum, Algorand, and where was the other one? I guess that was it. Those are DeFi plays. Those are really big DeFi plays, and I'm pretty excited about those. Tezos is there, and frankly, it probably has the best technology out of all these DeFi plays, but it has, I think, the least social engagement and the least adoption. And as we've seen for both Ethereum and Bitcoin, social engagement and adoption are huge. They're absolutely enormous. A lot of crypto, I gotta watch how I say this. You know how meme stocks are heavily influenced by social media and engagement and stuff? All of crypto is kind of like that to some extent. If you look at the rankings by market cap of certain crypto, and then you look at their Twitter accounts and see what their social engagement is, use that as a proxy for public engagement, the order of that is very proportional. I mean, you want attention. Attention is huge. Some people, you know, deride Charles Hoskinson for shilling ADA all the time, all day, every day, everywhere he goes. But I love that. I absolutely love that. I can't fault him for that. That's how crypto grows. You need public engagement. What else? So Chainlink is the Oracle play. Internet Computer is very sketchy from an organizational perspective. I don't own a lot of it, but their mission statement is so ambitious that I didn't feel like I should totally count them out. But we can talk about them at some point. There's some sketchy elements there. Decentraland is the NFT play. Biggest NFT play available on Coinbase, and their underlying technology is pretty darn good. What is it? Sotheby's in England, it's like an art gallery, started their bid in towards the NFT space with Decentraland virtual assets. And so I think this is probably one of the strongest NFT plays in existence right now. And once we get out of this, you know, Bitcoin bull market, I think we're going to end up seeing a lot more than the all-time high of, you know, what is this, 163? Oh, yeah, no, dude, 81 cent Decentraland is I'm going to just get that shit right now. There you go. 81 cent Decentraland is a steal. So a lot of people are selling it right now, and it's the 30th most held. It has a $1.3 billion market cap. We can talk about Decentraland a little bit more. I don't think I spent too much time on it in the crypto video, but Decentraland, I think, is a very solid NFT play. You don't really even need to be on the virtual reality game. It has a web browser-based alternative, and frankly, the game is ancillary to the actual function of being an auction marketplace for NFTs. Polygon is kind of a big deal as well. It's Ethereum's internet of blockchains. It's a layer 1 agnostic, layer 2 solution for scaling. It pretty much does everything proof of stake off of Ethereum. Some people are arguing whether or not it'll actually be necessary once Ethereum goes full proof of stake, if that solves all the scaling issues, but ultimately it provides, in my eyes, I'm not that worried about it because it provides a bunch more value in terms of interoperability, and it's been kind of adopted by a lot of different avenues, companies and a lot of different uses. I think Matic and its development team is really doing well, and Polygon probably has a really bright future ahead of it as far as connecting blockchains and making kind of the Internet 3.0 more seamless. So Ethereum is kind of that fundamental second generation, you know, cryptocurrency that is supposed to be able to power the Internet of Things. But if the Internet of Things is not one big entity and it's all just completely disjointed and none of it works with itself or each other, it'll be less of a good user experience. Polygon more or less aims to solve that issue, I think. So even though it's primarily thought of as a layer 2 scaling solution for Ethereum, it has a lot more, there's a lot more potential than that, I think. And that's mainly it. So, you know, we're up a little bit today, but given the bear market, I've put in more than 2,400 for sure. For sure. I'm currently at a loss big time on this. We were doing okay for a little while, but I think we essentially started entering the Bitcoin bear market. I don't expect a lot of big returns on this right now. Crypto, I have a long investment horizon. I think that's how you got to do it, especially with such a volatile asset. Some of these swings are nuts, dude. We went down to 1,400, and I had already put in more than 2,200 at that point. Anyway, and now we're all the way back up to 2,300, and it's been like a couple weeks. So remember, if you're going to invest in crypto, it's a wild ride. But always, I think, in my mind, just maintain a very long-term investment horizon, and you'll do okay. Wow, this did not end up being a brief video. Fuck me. All right. Well, I mean, I have most of this that I hold is in Ethereum. I've converted it to ETH2, and it's in a staking thing for Coinbase. I have a good bit of Algorand. This counter that you're seeing right here, those are the lifetime rewards, primarily driven by Algorand, a little bit by Tezos, but that's insignificant. Once we switch to ETH2, Coinbase will allow 6% interest. So that'll add to the rewards counter. It'll be going up a lot faster once that happens. Algorand gives you 6% already, so that'll be cool. I have a couple hundred Algorand. I have obviously just a fraction of a BTC because those are $39,000 right now. Ethereum Classic, I have a couple of those, but my average price on Coinbase is much higher, obviously, than my average price on Robinhood. I brought this about a good bit later once I actually made a Coinbase account. Couple of Link, good bit of Matic, a little bit of the straight up ETH that I haven't actually locked into my Ethereum 2 staking plan, and then Decentraland. Obviously, I just bought a little bit more. Did that already update? 34? I think I have more than that. And then I actually have a little bit of Stellar Lumens. Don't worry about that. I'm not. It's a cheap pick me up. There's some potential use there, but I am not one of those big bulls on Stellar Lumens, to be completely honest. And then obviously Cardano. We have a little bit, but you probably picked up that I'm a lot more bullish on Cardano than a guy that just holds 5 Cardano. This is my Yoroi light wallet. This is one of the native wallets for Cardano, so obviously I have a lot more Cardano. I have 500 Cardano at this point, and my total buy-in price was somewhere around the $1 mark. So I'm doing pretty freaking well on Cardano right now. I'm really happy with my return on Cardano. I currently have staking, so I'm staking my Cardano. It just automatically generates more Cardano, so you get free money. It's the definition of passive income. I love it. We have a little bit of rewards. You really do have to get up into like the 10,000 Cardano range before you start getting like a full Cardano plus every 5-day period. And I'll make a video maybe showing how to stake with Yoroi, just to, you know, just show you guys how that's done if you're interested. And that's pretty much it. Thanks for watching if you did watch.